Greetings. I'd like to talk about something that I think is of major consequence, and that is that I believe we have entered what I would describe as a major global financial earthquake, something that we have not experienced during our lifetimes. And we really have to go back to the post-World War I period when the British pound was dethroned as the world's reserve currency, and the world went into a no man's land of multiple currencies being used. And something like that has occurred again. The dollar is being replaced as the sole global reserve currency, and it's going to have consequences for us as the years proceed. Gold is returning as an important neutral reserve asset, replacing the dollar. We've entered an era of the shortages of essential commodities, with oil being the most important. And we believe that we've entered a period, a long-term, very bullish period for commodities: oil, copper, gold, silver, et cetera, possibly agricultural commodities. And in spite of the temporary weakness that occurred during May, we think that is nothing more than an interruption in this ongoing bull market. Before I talk about the specific commodity markets themselves, I want to discuss some of the general monetary and economic issues. The high debt level of the U.S. government has put the U.S. between a rock and a hard place. U.S. government debt is now 129% of GDP. 98% of countries with debt to GDP of 130% or more have defaulted in some way, either from partial non-payment of their debt or, more often, inflating their debt away. This next chart is a line graph representing the percentage that the U.S. budget spends on interest payments on the debt, plus all mandatory social welfare programs that are fixed by law and are subject to inflation adjustments. And as of March of this year, this total spending on these items alone accounted for 101% of the total tax collections of the U.S. government. It's estimated that on the trend that we're on right now, that by the end of this fiscal year, September 2023, we could be looking at spending that's as much as 120% of reduced tax collections. This is a serious problem, and it's a challenge for financing it. Because of this, the U.S. really is no longer in a position to tolerate a big recession, as has happened in previous decades when interest on the debt was much lower percentages. Also, tax collections are heavily dependent on the stock market profits, and as a result, in the last year, they've dropped off. Total government spending represents 25% of GDP, and any cutting of government expenditures will cause aggregate demand in the economy to decrease even more and increase the deficit. Today, deficit financing is heavily dependent on U.S. banks and primarily the Federal Reserve System. The commercial banks are no longer in a position, because the Federal Reserve raised interest rates so much, to be major buyers going forward of U.S. debt. What's happened is the value of the longer-term treasuries that the banks own have declined in value and face value, and it's forced the banks to seek solutions. In some cases, they've gone bankrupt. And we think that there's more of this ahead, and so there's going to be greater dependence on the Federal Reserve. In addition, the Federal Reserve must maintain an orderly Treasury market. The Treasury market is huge, and it underpins every other asset, not just in the U.S., but also globally. So maintaining order in the Treasury market is essential. There have been several times in the last few years when the Federal Reserve has been forced to step in and stabilize the Treasury market. In December of 2018, after 3 months of the Federal Reserve trying to tighten credit, it caused disorder in the market and forced the Fed to reverse its tight money policy. In August of 2019, there was a blow up in the repo market, and the Fed was forced to step in overnight to stabilize the repo market. The third time it happened was in March of 2020 at the height of the COVID crisis, and that was a time when foreign central banks became panicky net sellers of U.S. Treasuries for the first time in history and caused the Treasury to step in. Most recently, there have been partial step-ins once in the fall in October, and then again in March when we had some bank failures and withdrawals of uninsured deposits out of banks, and the Fed has created this policy which allows the banks to pledge their debt securities at face value rather than at market value to stabilize things. But we think we're probably just on the cutting edge of further bank failures and major problems in commercial real estate and leveraged loans. So we think we're within probably 3 to 6 months before there's another Treasury crisis and banking crisis, and the Federal Reserve is going to have to engage once again in quantitative easing. And they're going to have to do it before inflation's under control and really be forced into changing policy. Now, to just take a quick look at the U.S. government expenditures, 86% of the budget is considered to be mandatory. It's mandatory because of legislation that puts these spending programs in place for multiple years, and also has inflation adjustment arranged for the spending. So only 11% is what's considered to be discretionary, and the other 11% is defense, which also is discretionary, but in effect, it really isn't because of the situation we're in global politics. So the budget is very tight. It's going to we're going to continue to have deficit spending unless there's a political will to make changes in these programs, and that's not there at this point. We have had decades of deficit spending. Early on, the phrase "deficits don't matter" was very popular because when the federal government ran a deficit, it didn't upset anything because of the fact that our dollar is the reserve currency, and we've really abused that privilege for decades. When we got into the COVID pandemic crisis, the government stepped up with massive spending and massive dollar printing, which led to out of control inflation. And initially it was declared as being transitory or just temporary. In fact, it was not temporary and not transitory. And as a result, the Federal Reserve delayed its monetary tightening, but then accelerated it in the last 12 months. So coincident with this, with the government spending and the inflation, we have tight supplies of oil and other commodities for the first time in history. And this is because we've had decades of underinvestment in developing new supplies. And finally, this is beginning to come back and haunt global economic activity by shortages. So now governments that produce these commodities have taken a different tack, and they're not willing to sell more of their product than they can spend in the current year on goods and services from other countries. And so they used to would sell the extra amount and they'd invest it into U.S. Treasury debt. The problem now is that inflation is higher than the interest on U.S. Treasuries and likely to stay in that condition. and as a result, countries no longer want to sell it and buy U.S. Treasuries with it. At the same time, China has begun a very successful effort to get many countries, commodity exporting countries, to accept yuan instead of the dollar. And most notable is what they've been able to do with the Arab oil producers. And the Arab oil producers have agreed to accept yuan. China then says to them, whatever you don't spend on Chinese goods and services, you can convert to gold on the Shanghai Gold Exchange. And this is bringing about greater gold ownership and recognition that gold is a new neutral reserve asset. Gold is not subject to political control as the U.S. Treasury market is, and gold is a proven inflation hedge for decades or hundreds of years, and so its attributes are being recognized now. And you can see the change over time in the thinking of central banks and their ownership of gold and their ownership of treasuries. U.S. Treasury ownership peaked in the middle part of 2014, and in the last couple of years, it's gone into dramatic selling of U.S. Treasuries by governments. And they have, in many cases, have used the sales of U.S. Treasuries to buy more gold. Gold was being sold up until 2009 by the aggregate central banks, and the money had been invested into treasuries. And then in 2009, after the financial crisis, the attitude changed and they recognized the superiority of gold. And once again, they have started to acquire gold. And this only goes through 2022, but gold purchases have definitely stepped up. And then this next chart shows the percentage of central bank reserves that are held in gold and how it's changed over time. It used to be decades ago, it was between 45 and 75%. And then they went into a long period of net liquidation of gold, and the money was reinvested in U.S. Treasuries because it paid interest. But then, as I mentioned a minute ago, in 2009, after the financial crisis, there was a change of attitude once again and a step up of gold purchases. And now, in the last couple of years, gold purchases have accelerated, and we expect that it'll continue. This is another chart that shows a longer historical period of gold ownership by central banks. And as I said, in the earlier decades, between 45 and 75% was held in gold, and then it dropped off to as much as about 15%. And now we're seeing a step up in buying once again, and we think it's entirely possible that gold ownership could go back to at least the 40% area, if not higher. This is going to put tremendous pressure on upward price of gold from what the central banks are doing because of the small size of the gold market. Turning to oil, here is another chart that shows the shortages that potentially exist in oil. This is all inventories of crude oil and refined products in all OECD countries, and it represents 99% of all inventoried product in the world. And so, as you can see, there's been a dramatic drop-off since 2020 down to the current period. And we think that with the rising demand for oil, that by the fourth quarter of this year, we're going to see significant shortages develop, and the price of gold could begin to really skyrocket. Looking at the various oil-producing blocks, this is the OPEC 10, and you can see that their oil production peaked out in mid-2022 at around 25.5 million barrels, which was below their quotas. And it's interesting, they were below their quotas. They simply were unable to produce more oil to produce as much as their quotas would have allowed them to do. Now, in the last year, production has come down again, this time because they made a decision to cut production and felt that the market was getting a little bit loose. And basically what they did is they cut the amount of production comparable to what the Biden administration has sold from the Strategic Petroleum Reserve. So they've basically said, if you want to sell oil, U.S., we're going to reduce our production accordingly, and they've done so. Likewise with Russia, Russian production is modestly lower than what it was before the Ukraine war started. And essentially, it's well below their quota. And it's below the quota not because there isn't demand for their oil, but because so many of their fields are old. The Western Siberia fields represent about 50% or more than 50% of their production. And these really require Western oil service technology to keep them producing more. And of course, those companies have been forced out of the country because of the Ukraine war, and therefore we're not going to see any significant pickup in production there. Now, the one bright spot in oil production in the last decade has come out of the non-OPEC countries, with the U.S. being the primary one because of the oil shale discoveries. Non-OPEC production increased about 1 million barrels a year, and roughly 90% of that came from U.S. shale production. And now U.S. shale production is peaking out, and the only field that still has growth left is the Permian Basin in West Texas. And so there's only going to be a nominal increase in oil supply coming out of the U.S. oil shale fields, and unlikely to be any kind of major production anyplace else. And as you can see, global oil demand continues to rise, and it's expected to reach a new all-time high by the end of this year, which we think is going to create a significant shortage. Now, turning to gold, we've talked about official holdings of gold. This is a chart of ETFs that are gold ETFs relative to all ETFs. And here again, you see extremely low ownership of gold. And it's representative of all financial portfolios where the world holds about 1% of its assets in gold. And this is well below where it used to be. And the East owns much more. The West has been anti-gold for a long time. But we think that here again, the potential demand increase from the private sector is very likely. With inflation being higher than bond interest rates, bonds are no longer a great investment. From basically 1980 to 2020, bonds did very well in a low inflation environment. And then in 2022, bonds had a terrible return, worse than equities. And we think that they're going to continue to be a drag on portfolios, particularly the 60-40 balanced portfolios, 60% stock, 40% bonds. That 40% very well could be losing money every year. And portfolio managers are going to be looking to make some changes. And it's been proven that the risk-adjusted return of a balanced portfolio that has from 2 to 10% of its assets in gold tends to have much better risk-adjusted performance. And so you can see the potential for increasing even modestly if gold went from 1% to 2% of portfolios, it would put tremendous upward pressure on gold prices because of the small size of the market. Now, we think that we are very close to a breakout on all-time high in the price of gold. That could easily happen in the month of June, definitely in the second half of this year. Previous two times that gold has made major moves, it's gone up about 800%. If we were to do something similar here, we'd be looking at a price of about $8,000 an ounce. That sounds like an extremely high level, but frankly, you could make arguments that might be low compared to where it might go. We have government demand increasing. We have private sector demand potentially increasing. And then a third factor that could influence the price of gold and make a much higher price is that because governments have allowed their balance sheets to get so out of line with way too much debt outstanding, they could arbitrarily raise the price of gold as Franklin Roosevelt did in the 30s. And then they could take part of that gold profit that they would make at a higher price and exchange it for part of the debt that they have outstanding. If they did that, they probably would require a price that's well above 8,000. Whether or not that happens is hard to know, but we think the fundamentals are extremely positive for gold, and we're going to see a much higher price. If gold does well, we think the stocks will do even better. This is a chart of the GDX, which is the GDXJ, the junior mining, gold mining companies that are involved in exploration and development and non-producers. They are selling at an extremely low price relative to the price of gold. And these stocks could be absolutely explosive to the upside if once gold makes a new all-time high. So that's sort of a quick summary of what we see going on. Just to summarize, we've entered an era of high inflation that we think is going to be with us for at least the next decade. The U.S. standard of living could decline as the government has to deal with its deficit spending and with the fact that the dollar is no longer the world's reserve currency and may decline in value. And then we believe it's an environment that's very bullish for commodities and precious metals, and that we think that these are going to be superior returns coming out of those things. So if you would like to discuss this, if you have questions, or you want to challenge me on anything, I would enjoy talking with you. Please give me a call at 203-554-4003. I look forward to talking with you, and have a great day. Thank you.